So friends, it's my privilege to introduce the convention's keynote speaker, Mr. Sankaran Naren, Executive Director and CIO at ICICI Prudential AMC. Now, how do you introduce a guru? I think the best is not to introduce him, give him the extra time so that he can share his wisdom with us first thing in the morning, first thing in the new year. Okay? Over to you, Mr. Naren. We are all ears.
So it's a pleasure to come back to MFAC, as it is now called, and speak after a few years. So, you know, the topic was extremely interesting because the location you have chosen made it even more interesting because am I audible? No? It's audible. Am I audible? So the location was very interesting because we are doing it in Hilton Manyata Park. And Hilton Manyata Park is owned by Embassy REIT. And the single largest domestic shareholder after the promoters in the REIT is ICICI Mutual Fund. And that is the part of this entire multiple asset story that, you know, we have ended up as being one of the largest shareholders in the REIT. And that REIT owns this hotel. Normally, you are used to thinking that companies own hotels. But in this case, it is actually the REIT which owns this hotel. And I was very glad to know that this is one of the best convention centers here. So I hope you give a good feedback so that will be very good for my investment in the Embassy REIT. So that was interesting. The second was, which was personal, that actually Sandeep was the person who appointed me as head of research and got me into this entire research area. I was doing a part research job. So when he set up a mutual fund in quant, it was very interesting for me. His style and the style that we have in ICICI Prudential to manage a lot of other people's money is different. He's also a believer in multi-asset. I think his entire thing, but Sandeep was my boss for 15 months and gave me the research opportunity, which I later converted into a fund management opportunity. And ICICI Prudential, we have a style which is pretty different because finally at the goal of ICICI Prudential is to manage money for all the people of India in all the asset classes. So that's the goal. So I have to thank Sandeep for giving this opportunity to me, and I think he's the next speaker after me. So I thought it was very interesting that this was the situation. I have to thank the entire people in Bangalore and everybody around the NPCI system. I believe that the topic is for dominance as part of MFAC. If you go back to the 18 years that I worked in ICICI Prudential, the mutual fund industry has become possible to be dominant in the entire financial services space. And the reason is the fact that it has become very easy to do a digital transaction. If you go back to 2004 October when I joined ICICI Prudential, at that point of time it was not possible to do a digital transaction easily. And let's say I'm in Bangalore today and I want to invest what is there in my bank account in a debt or an equity fund. The whole process would have been very, very cumbersome. Most of the time you had to search for an ICICI branch to give a slip to actually invest. And if you needed money tomorrow morning in your bank account, it would have been very difficult if you had to take out money from a debt fund to invest. But thanks to the good work done by NPCI and the work that had to be done was done by NPCI and all the people in the stack. What happened was this entire process has been made extremely smooth, that even though you are sitting in MFAC in Hilton Manyata, you will still be able to do transactions for many of your customers using iProTouch or maybe the BSE Star platform or anything like that, that your business is no longer dependent on many things. And that basically is the reason for the entire dominance which is possible in the financial services space. What does that mean at this point of time is that your business is not limited. And I would say the business was very limited in 2004. Although many of us were unhappy with the way the entry load got abolished and various other things at that point of time. The way the entry load got abolished, the way super institutional plans disappeared, the way the costs in the industry have come down significantly between 2004 when I joined the industry and 2022, and the ease with which digital transactions can happen at this point of time, that is the reason why we are going to have a very, very dominant industry in the next 10 years or 20 years. And in my view, the index and ETF industry is also going to play a role. Like the government did a beautiful job of starting this entire Jandan model, which also allowed everyone to have bank accounts. And due to that, what happens is we are a situation where everyone has a bank account. You are able to do a lot of things on the KYC side, and then you are able to do things digitally. So many people have mobile phones. Now you're going to have 4G, you have 5G. So you have a situation where the dominance part of it is going to be phenomenal over the course of the next 10 years, 20 years. Even today, I don't think none of us could have guessed what all has happened in the last 10 years. So I keep telling people that when I joined ICICI Mutual Fund, we used to have 2,000 crores in equity AUM in October 2004. Thanks to the support of everyone in this room, we have reached 250,000 crores in equity and hybrid. And I must thank all of you for this. And it happened only because of all of you in this room. So today we have about 230,000 crores in debt. I don't see why that 230,000 crores can't become 23 lakh crores. And that I believe is very, very easy in my opinion, if all the people in this room can actually move forward. And how does that dominance work? See, 10 years back, what we realized was from the global financial crisis, what we realized was we made equity the sole focus of mutual fund existence. Due to that, what happened was the business went away from 2008 to 13. What Nimish and I felt was that we have to make a lower conservative product like balanced advantage. Due to that, what happened, despite various setbacks, the industry has kept on growing. What we feel is, if you want the industry to continue growing in a massive way, and this does not mean that equity or hybrid won't grow, but I'm saying we want multiple growth engines, and that's why we call it multi-asset. So if you look at it from the time we started to talk on gold and silver, every day gold and silver goes up, making it very, very boring actually for me. But the fact is that you've got so many growth engines. You've got one equity growth engine, you've got one balanced advantage growth engine, you've got an asset allocator growth engine, you've got a multi-asset growth engine, you've got a debt growth engine. And it is through all these growth engines that you can have every day, you can keep growing. And that is the way in which the whole industry can keep growing and become dominant all the time. And a mutual fund, as you know, has resulted in this entire Sahi campaign at this point of time. So why are we in this multiple asset class framework at this point of time? We are in this multiple asset class framework because from 2008 to 2021, we had a situation where the central banks were printing. So we had a printing press in Washington. We had a printing press in Brussels. Both of them were printing money left and right. But both those printing presses are closed. Now only the Tokyo printing press is open. Even the Tokyo printing press is threatening to close down. See, if all the printing presses close down, then what happens is all the big companies of India also have to borrow locally. Then what happens is debt becomes a great asset class. So, due to which debt became a great asset class at this point of time. Last year we gave a cautious call through ABCDEF, which was asset allocation, booster STP, be conservative, invest in debt, invest in floater, do equity savings, equity arbitrage, and do fund of fund. It kind of worked. What we got wrong last year was that we could have given a buy call in June, which we didn't. And that's something I'm introspecting. That is because the people in this room actually ensured that SIP bet FII, a three-letter word called SIP, bet FII. And that again, all of you deserve credit in this room. But where are we today? First is the central banks are closed. They have closed their printing presses. The second is what happened. Why did we give this call in October, November for gold and silver? There is another printing press which got closed, which is the crypto printing press. What was happening was that this crypto was an alternative to gold and silver. But when that FTX issue happened, people lost confidence in crypto. People said, what is this crypto? That one person called that is Sam managed to run away with $8 billion of money. So people lost faith in crypto. So because the central banks closed their printing presses, debt became attractive. Because Sam ran away with $8 billion, gold and silver became attractive. Equity was always a structural asset class. So InvIT and REITs have come up. Would you have ever imagined that a hotel can be owned by a REIT? This entire complex is owned by a REIT. The entire Manyata Park, all the office space here is owned by a REIT called Embassy REIT. So I believe REIT has become an asset class. So you have a situation where it's very, very interesting that so many asset classes have become part of investing. Gold, silver due to crypto, debt due to global central banks, REIT, InvIT due to the way things have shaped up. And that is what we are trying to tell you at this point of time. When will it end? It will end if tomorrow Jerome Powell comes in the middle of the night and says, I am starting quantitative easing. But if I ask anyone in Goldman, if I ask anyone in Morgan, if I ask anyone in Bank of America, they all say it won't happen immediately. But yes, if that were to happen, yes, I agree, then it's no longer true. But I don't think anyone is talking about it. Does it matter that US reduces interest rate? No, it doesn't matter. It is only if quantitative easing starts that we have to think about, again, whether debt is a structural asset class or not. Because otherwise the gap today between US interest rates and Indian interest rates is record low. It has never been so low. Today, if you are an NRI, you get 5.2% in dollar deposit and you get 7% in rupee deposit. So the gap is very, very low. I've never seen that gap be so low ever in my life. And that is mainly because Indian macro was managed much, much better than global macro over the last 3 years. And that is the reason at this point of time. So are we in a low volatile world? Yes, this year we were in a low volatile world in India because SIP bet FII. I don't think it will last forever. I think even yesterday showed that India won't be in a low volatile world forever. I think in the next 10 years, India will also be more volatile. Because last year what happened was at the start of the year, the liquidity in the banking system was some 10 lakh crores. That 10 lakh crores of liquidity was the reason for the low volatile world. Today that liquidity has become 3 lakh crores. Because that liquidity has come down, we have a situation where volatility will certainly increase in the next 3 years. So therefore, we will be in a higher volatile world, which means that asset allocation has a much better role to play. And we will not have such low volatility as we had in equity markets, as we had in 2022. And that is the view we have at this point of time. Does it mean equities ceases to be a structural asset class? Certainly not. I think equity will remain a very, very good asset class. India has very good fundamentals. India is one of the few countries which is geopolitically in the middle. It is neither part of the China axis nor part of a US axis. We are in the middle. India has a growing workforce that it has a lot of educated people who are getting good jobs. And we have a situation where India is growing. Many other countries struggle for growth. So it's not that India is a worrying decadal story. India has only one problem. The only problem at this point of time is valuation. This is something we put on our fact sheet. I never imagined when we started putting this in our fact sheet years back that it will work so well. And if you open our fact sheet every month for 15 seconds and see this color coding, you will clearly be able to see periods when you have to put aggressively money in equity, and see periods where you have to be very careful, and see periods where you have to be in the middle. And the reason why we became balanced advantage fund kind of product is too long it has spread in the green, in the yellow period. But otherwise, when it went into green, we have come on TV and told people invest today. And when it went into red, we told people that you have to be cautious. But I'm amazed as to why this worked. And you can go and look at our fact sheet every month. Over the last 10 years, you'll find this has worked so beautifully. Like even today, we are in the yellow phase. In the yellow phase, things like asset allocation works very, very well. Clearly, there's a case for global investing, partly because global markets have done very, very badly. There are markets like Brazil, which has delivered 0 return in 10 years. China was much better 3 months back. I can't believe that China gave 35% return in 3 months. But Brazil has given 0 return in 10 years. So the reason for global investing is that no returns came in 10 years. To give credit to us, we launched a US fund 10 years back. And at that point of time, people didn't give us money. Most of the people launched US funds recently. And after they were launched, they didn't give returns. And we believe very strongly in mean reversion. So we like when things do badly. And actually, when things do very well, we are very scared. And today, on that basis, today we are more comfortable. It's not that 1 year back we didn't like some of the markets. We did like some of the markets. But we think there's a case actually to invest some part of the money. Obviously, we think the opportunity is not large because the limits which are there with every mutual fund is small at this point of time. And the case for investing in gold, every day if it goes up, I'll be more moderate, which is the reason we prefer much better at this point of time over a fact that, it's much better to do it through the multi-asset route rather than just in gold or just in silver. But if gold and silver were to come down again, I would make a separate investment in gold and a separate investment in silver. But right now, I'd prefer to do it through the multi-asset route or the passive multi-asset route. I did spend time on this, so I will not spend too much time explaining. So the basic approach, we are a big believer in acronyms because it's easy to communicate. Our acronym for 2023 has been SAFE, which is that you do systematic investment plan, you do freedom SIPs, you do STP, you do Bister STP, because markets are not cheap. India has a structural story, so all 4 are very attractive. We believe in asset allocation. We have believed in asset allocation right through. Maybe if the market goes out of yellow into green, we may change our view and say much more pro-equity. But right now, we are believers in asset allocation. Also because we like data as an asset class. We like gold and silver in a small way. We like global investing also in a decent way. So that's why we are big believers in debt. We believe that the entire audience here is underinvested in debt, barring a few exceptions. We would love to see that Karnataka has a very, very big retail debt AUM. We don't have it. It need not be only in 1 or 2 products. It can be in any of the products, in our opinion. And we are big believers that you should have some money as a parking product in a product like equity savings category or an equity arbitrage category, which you'll use in panic conditions to move to equity. And even though the riskometers are high in these products, we like these products because we think these are good products to park money temporarily and keep that money for investing in any panic. As you would have seen, periodically panics do come, and those opportunities can be used if you have money parked in these products. So this is broadly our approach for 2023. It has become uninteresting that there are never opportunities which come up except in mid-year. In 2020, at least in March, we gave a call to invest aggressively. In 2022, we never gave that call to be very aggressive in equity. But what to do? We didn't give it. Why we didn't give it? Because our models did not tell us to be very positive. Our models did tell us to be very positive on gold and silver last year. So if you take our asset allocator fund, we never used to have gold a year back. But in that fund, we built big gold. And because it's a large fund of 20,000 crores, nearly 19,000 crores, so we almost bought 1,600 crores of gold during the year. And so it's not that, in a fund like asset allocator fund buying 1,600 crores. So if you look at a multi-asset fund, which is about 14,000 crores, we ended up buying 400 crores of silver. Buying 400 crores of silver is not small. So our belief is that somewhere, while we have not been able to get money in gold ETFs or in silver ETFs, in the products like multi-asset or asset allocator fund, we managed to buy gold and silver at possibly what we realized retrospectively was a very good time. See, or in a fund like passive multi-asset, we managed to buy gold miners and we managed to buy gold at about the right time. Sometimes you can go wrong also, but that is the beauty of multi-asset. But I think for a long time, multi-assets is a very, very interesting strategy till the time equity becomes cheap. And the day equity becomes cheap, we will be in a situation where we will try our best to communicate that it has become cheap, which is the area which is costly. Many of the small and mid caps are very costly at this point of time. The indices are not as costly as some of the stocks. That's where we are. So I think this is broadly what we wanted to convey. What is it I'm unhappy about? Over 2020, we tried our best to communicate that there is a big opportunity in buying value, buying stocks away from quality at costly price. We tried our best to communicate, but it failed miserably. And at that point of time, quality at what I call absurd price was trading at ridiculous valuation compared to value, compared to PSUs at that point of time. If you look at where the money went at that point of time, it went into all those quality at absurd price stocks. Today, if you look back and look at the last 2 years, you will find that the gap is 50% between quality at absurd price stocks and PSU stocks or value stocks, etc. As the industry becomes more sophisticated, I was under the impression that people would be able to see that past returns is not equal to future returns. But that did not happen. So the investor experience in those funds is so much behind the benchmark. And so people will finally blame active management. But the reality is people have to blame active allocation, not active management. And in fact, most of the value-oriented funds at that point of time have delivered 30%, 40% alpha in the last 2 years. I do agree in the year before that they did very badly, but most of the people who ran those funds across mutual fund industry spent a lot of time that year saying that the future looks much better than the past. But people are not willing to accept it at that point of time. So essentially what happened was the industry investors in the mutual fund industry got negative alpha if you look at it at that point of time. Today, for example, there are many small and mid caps trading at absurd valuations, And the price to earnings and price to book of those stocks are ridiculous. When I tell people that look at the price to earnings and price to book of mid cap stocks and small cap stocks, they say we are investing for 20 years. If you go back and look at the FANG stocks 18 months back, people told me that all the FANG stocks will never ever fall because you are using Facebook, you are using Amazon, you are using Microsoft, you are using Google Maps, you are using Google search engine. Just look at what happened to those stocks. Today, the same thing is being told that I'm happy buying a price to book stock in small cap at 10 price to book. When you buy a price to book stock at 10 and 8 and you buy a price to earnings of 70 in small cap and mid cap, you have already paid for all the growth over the next 10 years, 20 years, 30 years. But I find it impossible to convince people that the risks are much higher than the returns. So it's the same quality at any price story of 2020 end. But it's impossible to convince people that the risks are much higher than the returns at that point of time. The problem is timing, because it is not possible to get timing right. And if it was possible to get timing right, it would be nice, but it isn't possible to get timing right. And that is the challenge. In 2020, November, when we did a call where we went stock-wise to explain to people that each of the stocks was cheap, we didn't know it would be the turning point, but it turned out to be the turning point. But if it had gone on for 4 to 6 months, it would have been even bigger nightmare. But the reality is that such predictions are impossible. One of the learnings that we have from our investing careers is, beyond a point, timing is difficult, but we can guess over valuation. It is very simple to know today when you look at the mid-cap stocks, what is the PE of the mid-cap stocks and what is the price to book of the mid-cap stocks. When you look at the small-cap stocks, it's very easy to look at the price to book of the mid-cap stocks and price to earnings of the mid-cap stocks. And it is your decision where you take out money from and where you invest in. And when people do SIPs, you have to do SIPs in the right category. So if you do SIPs, for example, today in a flexi cap category or a equity aggressive hybrid category or a multi-asset category, it is much, much safer. But assume you have done SIP in Brazil fund for the last 10 years. Do you think you would have got return? The answer is certainly no. So you have to choose the SIPs also in the right category. And that is your responsibility, not the responsibility of the industry. It is clearly the responsibility of you to choose the SIPs. So everyone believes that SIPs always deliver return. Go and look at the SIP returns in Brazil. Go and look at it. You will find what is the SIP returns. So it's very important that you have to choose SIPs in the right category. Which are always the interesting categories? Clearly, categories which are more defensive are always safer. You can even do SIP in a debt fund, nothing wrong. And that is clearly in your domain, not the domain of the manufacturer. As a manufacturer, we are today running 4,80,000 crores. As an AMC, our AMC's goal is to run more and more public money in the right way. And from our side, we will tell where we want the money to come. And as you can see over the period, whether it is 2022 or 23, we have been careful. And when we want to be aggressive, like 2020 March, we will try our best. And that is what we wanted to communicate. So thank you all from MFAC for giving us this opportunity. And I believe the outlook for your business is absolutely fantastic. But you have to do the right things for your investors. You should not care about what is the outlook for anything. And that's how I see it at this point of time. Thank you all.
Thank you. Thank you, Mr. Naren. Please stay on stage. May I invite on stage Srikala Bhashyam, Vice President, and Mr. Jayaprakash Pai on stage to kindly give a memento to Mr. Naren.